Imagine waking up tomorrow to discover that 90% of your money has vanished. Not stolen, but simply ceased to exist. This isn't just a thought experiment. In 1929, millions of Americans experienced exactly this when the banking system collapsed. Today, we're going to explore the system that made that possible and why it still keeps economists up at night. Every day, millions of people walk past towering bank buildings, assuming their money sits safely inside, waiting for them to withdraw it. The truth is far more complex, and it starts with a story from medieval Europe that would change the world forever. In 17th century London, the streets were dangerous, and carrying gold meant risking your life to thieves. Enter the goldsmiths, who offered a revolutionary service. They would store your gold safely in their vaults and give you a paper receipt in return. These receipts soon became more convenient than carrying gold, and people began trading them instead. The goldsmiths noticed something fascinating. On average, only about 10 to 20% of depositors would reclaim their gold at any given time. Take Thomas Smith, a prominent London goldsmith in 1660. His records show he had £10,000 worth of gold in his vaults, but issued receipts worth £30,000. He was creating money out of thin air, and his customers were none the wiser. This practice would eventually evolve into modern banking. But here's where things get really interesting. Modern banks have turned this simple concept into something far more powerful: the money multiplier effect. Imagine dropping a pebble into a pond. The ripples spread outward, creating larger and larger circles. That's exactly how money multiplication works in our banking system. Let's follow the journey of Sarah's $10,000 deposit into First National Bank. Under traditional banking rules, the bank must keep 10%, $1,000, as a reserve, but can lend out the remaining $9,000. This is where the magic begins. Tom borrows that $9,000 for his restaurant renovation and pays his contractor, who deposits it in Second City Bank. Now, Second City Bank can lend out 90% of this new deposit. That's $8,100. The process continues. Round 1, $9,000 available for lending. Round 2, $8,100 available for lending. Round 3, $7,290 available for lending. And on it goes. The total potential money creation from Sarah's initial $10,000 deposit? A staggering $100,000. This isn't magic, it's mathematics. The formula is simple but powerful. Initial deposit times 1 over reserve ratio. With a 10% reserve requirement, $10,000 times 1 over 0.1 equals $100,000 in potential new money. But this system has a fatal flaw. In 1907, the Knickerbocker Trust Company faced a crisis when rumors spread about its risky investments. Within 3 days, desperate depositors withdrew $8 million. Nearly all of the bank's reserves. What followed was America's worst financial panic until the Great Depression. Speaking of the Great Depression, let's compare two devastating crashes. In 1929, over 9,000 banks failed when the stock market crashed. The money multiplier worked in reverse. As banks failed, they destroyed money faster than it could be created. Depositors lost $140 billion in today's money. Fast forward to 2008, and we saw this effect in modern times. Banks had created massive amounts of money through mortgage lending. When housing prices dropped, the multiplier went into reverse. Banks reduced lending. The money supply shrank. This forced asset sales. Prices fell further, creating a devastating feedback loop. The fractional reserve system creates multiple layers of risk that affect everyone, whether they realize it or not. One of the most dangerous aspects is the system's inherent fragility. Modern banks are deeply interconnected through a complex web of loans and deposits, meaning problems at one institution can quickly spread throughout the entire financial system like a virus. We witnessed this frightening reality during the 2023 Silicon Valley Bank collapse, where the speed of modern banking turned deadly. In just 48 hours, panicked depositors withdrew an astronomical $42 billion, causing the bank to fail faster than any regulatory system could respond. This system also creates devastating boom-bust cycles that ripple through the entire economy. During good times, banks tend to create excessive amounts of money through aggressive lending, fueling unsustainable booms in various sectors. But when these bubbles inevitably burst, banks suddenly slam the brakes on lending, creating credit crunches that hurt both businesses and workers. It's like a monetary feast followed by a famine, and ordinary people bear the brunt of these violent swings. Perhaps most troubling is the moral hazard built into the system. Large banks operate with the knowledge that they're too big to fail, essentially holding a government guarantee that they'll be rescued if things go wrong. This implicit safety net encourages increasingly risky lending practices, while taxpayers are left holding the bill when things go south. The 2008 financial crisis provides a stark example. The initial bailouts cost American taxpayers an astounding $498 billion, effectively privatizing profits while socializing losses. Today's system is even more precarious. In March 2020, the Federal Reserve eliminated reserve requirements entirely. Theoretically, this means the money multiplier could be infinite. The numbers are staggering. The global money supply is now over $100 trillion, but physical cash represents less than 10% of that amount. This system profoundly affects everyday life. Take housing. When banks increase lending, they create new money that chases limited housing stock. In 1960, the average house price was $11,900, about 2.5 times the median yearly income. Today, it's $420,000, over 5.25 times median income. This isn't just inflation, it's the money multiplier at work. The pattern repeats globally. Japan, 1995. The multiplier shrank from 11.5 to 9, helping trigger the lost decade. Sweden, 1992. A multiplier of 15.7 created a massive property bubble. Thailand, 1997. Excessive multiplication of money through loans triggered the Asian financial crisis. Modern technology has supercharged this process. Electronic transfers mean the multiplication of money can happen in days instead of weeks. Each new loan creates new money faster than ever before. Before we discuss solutions, we need to understand the full scope of what this system costs us as a society. The economic instability created by fractional reserve banking manifests in predictable financial crises that occur roughly every 10 to 15 years, like clockwork. During these crises, millions of people lose their jobs, retirement savings get wiped out in market crashes, and countless small businesses collapse under the weight of sudden credit crunches. It's a cycle of destruction that has become so normal we barely question it anymore. The social costs are equally devastating. We're witnessing the greatest wealth transfer in history, as the system drives ever-widening inequality between those who have access to newly created money and those who don't. Young generations face an unprecedented challenge. They're being systematically priced out of the housing market, forced to take on enormous debt just to achieve what their parents could afford on a single income. Meanwhile, local community banks that once formed the backbone of small-town economies are being swallowed up by massive institutions deemed too big to fail. On a personal level, the impact of this system touches every aspect of our financial lives. Our savings constantly lose value, forcing us to take increasingly risky investments just to preserve our wealth. Many people feel pressured to take on debt simply to maintain their standard of living, creating a treadmill of perpetual borrowing. Even retirement planning has become a moving target, requiring ever larger nest eggs as the purchasing power of our savings erodes year after year. This isn't just about numbers on a spreadsheet. It's about the quality of life for millions of people who work hard but find themselves falling further behind. So what can be done? Central banks try to control the multiplier through interest rates, their primary tool today, capital requirements, the Basel Accords, open market operations. Meanwhile, alternatives are emerging. The Bank of England is researching central bank digital currencies. Countries like Iceland have proposed sovereign money systems. Cryptocurrencies like Bitcoin offer a fixed supply that can't be expanded through lending. The story of fractional reserve banking and the money multiplier is the story of modern civilization itself. A system that has enabled unprecedented growth, but also created unprecedented instability. Each dollar in your account represents not just money, but a promise built on promises, multiplied through the banking system. If you've made it this far, you now understand more about banking than most people ever will. Hit subscribe for more deep dives into the hidden systems that shape our world, and leave a comment sharing your thoughts on this fascinating but troubling system. Until next time,
This is the Wealth Squad.
bringing you the stories behind the numbers.